Welcome to Talking Property. Today my guest is Louis Christopher and we're discussing the state of the Sydney property market in the first half of 2018. Louis, welcome to Talking Property.
Good to be here.
Louis, how has the Sydney property market and the inner west specifically performed in the first half of 2018?
It's been a weak housing market, Peter. Auction clearance rates have fallen over the period. Days on market has increased, so it's been taking longer to sell. Some resales have been coming through, been at a loss. This is probably about some of the weakest conditions I've seen in some years now for the housing market.
People selling Sydney real estate at a loss, that would be a long time since we've seen that in the market, Louis.
Correct, yes. I think the last time we saw that was probably 2011 briefly, and then prior to that 2008. When the market was getting almightily concerned about the GFC.
Is there a single indicator that consumers should follow to track the property market, whether it be the auction clearance rate, median house price, stock on market, days on market?
There are a number of indicators, and fortunately that's a good thing because there is no foolproof indicator on the marketplace. I regularly follow the auction clearance rates. I think they provide a here and now indicator of the state of the health of the housing market. But I also like to follow total stock on market, so whether listings are rising or falling. And for Sydney, they've definitely been rising. They're up by about 35% compared to this time last year. Yet another indicator the market has been slowing rapidly.
So stock on market's been up. What about transaction volumes?
Volumes are well and truly down.
Stock's up, volumes down.
Now transaction volumes generally are a bit of a lagging indicator because you have to wait for the valuer general to report in all the sales. So that's one thing where it's really hard to use that indicator as a leading indicator. It's more lagging, but nevertheless sales volumes are down.
Louis, during the boom, in percentage terms, apartments grew at the same rate that houses did, which was a surprise for me personally to see apartments so resilient. How are apartments performing relative to houses?
I think it actually depends on the price bands, Peter. So when we're looking at the lower end of the market, apartments are falling, but perhaps not as much as what we're seeing it towards the upper end of the market. And also depends on the location as well. In Sydney's northwest, we're seeing some pretty large discounting going on for units, and there has been a lot of unit activity in that area. It's the case with the southwest as well. When I look at, for example, the eastern suburbs, we are still recording unit price falls, but probably not to the same magnitude. And then in your area, the inner west, once again, I am seeing falls for units as well as houses. I would put the inner west right now is running at about at the Sydney average. So about 4 to 5% falls seem to be occurring.
And is that for apartments and houses in the inner west or just for apartments?
Generally for apartments. Now, when we look at for houses, it depends on the price range. So all price ranges are falling from what we can see. The only range that I can see that's holding up, and these comments are for overall Sydney, are for properties, say, above $4 million. This is for the very, very upper end of town. That seems to be holding, and I'm not overly surprised by that because the local economy is still doing well. But if I look at the price range between $2 to $3 million, that segment of the market seems to be hurting the most. So we're seeing a lot of discounting there. We're seeing some vendors reselling at a loss. It really does depend on the property type and the price range and the location we're talking about. But overall, what is not in dispute is that the Sydney housing market is falling, and there's very few places to hide right now if you're a seller.
Now, coming into 2018, Louis, you held a view that the Sydney market was going to increase by 4 to 8%. And in April or May, I think you revised that forecast down from 4 to 8% growth to 0 to -4%. Can you tell us what you were seeing in the market for you to change your forecast there?
Yes, well, I think if we take a step back in time, we made our initial forecast in October 2017.
Yes.
And at the time, auction clearance rates were slowing, but when I looked at previous years, they were still above levels where we had price falls. So they were higher than what we were recording in 2011. They were higher than what we were recording at the same time in 2008. Two point intervals in time when we had house price falls in Sydney. So I considered that information, and also the fact that the local economy was still doing very well, interest rates were low, and the population was still strong. So at the time, it appeared as though the market was heading for a slowdown, but we didn't believe the prices would fall to the magnitude they have now. What happened earlier this year was that the information that was coming out of the auction market suggested that the market was deteriorating further from where we were at Christmas. And based on that information, we had to make an adjustment and revise our forecast down. And that was also on top of new information that was coming through in the banking sector, that the banks were starting to really focus on claimed expenses when people were applying for loans. And that has had the effect of further tightening up the credit markets.
So this is the whole exploration of the liar loan segment of the market, where people were overstating income and underestimating expenses?
That is correct.
So Louis, tell us a little bit more about how expense claims are impacting on the property market.
So previously, before we saw banks start to restrict this part of the market, a borrower could basically fudge the numbers when it came to expense claims. And expense claims are important because what the bank's trying to work out is your net income after expenditures in terms of your capacity to take on a mortgage. And so what was happening was that you could put in a false expense claim of, say, $2,000 a month. You put that into the bank, and the bank wasn't really auditing whether you were spending $2,000 a month or you were spending a lot more. As it turned out, lots of people have been spending a lot more than what they said they were to the banks. And so what's been happening now is the banks have been doing proper audits of this and really clamping down on this part of the market. And from what we can see, there's been a number of property investors out there where they were putting in expense claims for the loan of, say, $2,000, $3,000, but in reality, their monthly expenditures were up to $8,000 to $10,000 a month.
It's kind of scary to think that that's systematically gone on in the marketplace.
It's been going on for quite some time. And so now there's an adjustment going on because of it. And what we're seeing are some investors and homeowners who cannot refinance their loan. So the banks come to us and say, look, we cannot continue on with this loan anymore. You're going to have to find another bank to lend you the money. We're going to be calling in the loan, right, because of this issue. Go and find another bank. And they're struggling to find another bank.
I'm fine with prudent lending measures, Louis. I just don't know why we've, as a society, imposed those measures on the market at the end of a 5-year boom when everyone's greatly indebted, because it's having a very disruptive impact on the market, isn't it?
Well, true, Peter. I mean, it's a lot to throw at the market, which was already reeling from action that's been occurring from 2015 onwards.
Yes.
So this later move that's been going in the market is just one in a long series of actions which have been restricting credit growth.
Well, you're talking about government intervention there, Lou. Let's take a close look here at your slide on tightening the screws and loosening the screws and
Yes.
government intervention. And I wouldn't like to be a property forecaster when you've got a government that meddles with the market like that.
Yeah.
Tell us there of tightening the screws and loosening the screws, in your view, what's had the biggest impact?
The trigger to this recent downturn was actually what happened last year in mid-2017 when the Australian Prudential Regulation Authority, or otherwise known as APRA, came out saying that we are now going to restrict interest-only loans. That banks, when they write new loans, only 30% of new loans can be interest-only. And this was across the board in terms of their whole book, both for property investors and owner-occupiers. And I think what actually shocked many pundits at the time and commentators, and I was surprised by the numbers, was the high proportion of loans which were interest only that were written out in the marketplace. Basically, APRA came out and stated, look, the number's actually at 40%. So 40% of new loans written were interest only loans. It's quite a large component. And so that's actually affected the market. Now, the reality is right now is that the banks are now well under the new threshold set. So in theory, they should be out there lending money. But what's happened since that time, since mid-2017, are two things. Firstly, as we've just discussed, the bank's now focusing on expenses, and second, the confidence in the market's completely gone. So there's hardly any property investors out there at the moment, and they're very momentum orientated. When things are good, when the prices are rising, they want in on the market. When prices are falling, investors will generally be the first to sell, and those would-be investors who are on the sidelines stay on the sidelines.
Investors don't like catching the falling knife.
They don't at all.
Yeah.
So that's what's been going on in the marketplace. But yes, this was definitely triggered by mid last year when the bank started clamping down on interest-only lending.
Cutting back to Sydney, we've seen a lot of new dwellings enter the marketplace over the last 3 years with all of the apartment high-rises, and we're going to see a lot more in the next 3 years as well. On the ground, we're seeing foreign buyers of yesteryear that can't actually settle and need to divest their investment per se. At the moment, what are you seeing with the rental market with all these new dwellings coming online?
It's dependent on exactly which area we're talking about. Overall for Sydney, vacancy rates are not elevated, but they're not at the lowest level they have been. The lowest level we recorded was about 1.4% for Sydney. We're now at about 2.3%. So vacancy rates have been trending upwards in recent times.
And asking rents?
Asking rents are largely flat. But then again, it does boil down to population growth rates. So if we were to see a cut in migration levels over sometime over the next 2 years in Sydney, that may well trigger a deeper slowdown in the rental market for Sydney.
Louis, excellent information today. Thanks for joining us on Talking Property.
Good to be here, Peter. Yes, I know it's a bit of a downward discussion at the moment, but it's important we always get the facts out there.
I think it creates great trading opportunities as well. We always encourage people that you should upgrade your family home, your primary residence in a flat market. And someone that's selling $1 million home now to buy a $2 million home, this is actually a better time to do so than during the heat of the market, the heat of the boom.
Absolutely. For owner-occupiers, upgrading in this market is a pretty good point in time.
Terrific. Thanks, Louis, and thank you for joining us today on Talking Property.